And now let's take a look at the Asian equity markets. Let's bring in Jameel Ahmad, who is Chief Analyst at GTC. So MSCI is now cutting dozens of Chinese companies from its global benchmarks. How does this index rebalancing fit into the broader landscape of how global investors are approaching and allocating capital to China versus other Asian developing markets, for instance, India?
Well, India is an interesting topic right now because you actually see that India is the success story of the 2020s so far. We've had so many challenges for the world economy over this decade. If we go from the pandemic, geopolitical tensions, high interest rate policy. But a lot of the good news that we have had is actually coming from the side of the Indian economy and its economic growth engine. In fact, if you look at India's headline GDP figures, there is some resemblance and some memory towards how the Chinese economy was getting a lot of momentum, let's say in the early 2000s, 15 years or so ago. So I do see some resemblance there. And then when you also consider that over the longer term, India is set to become one of the largest economies in the world, beating all of the developed economies and so forth. It's going to be the top three within just a number of years from now. But the capital markets in India are actually still pretty infant when I talk about the development for a large international scale. So I think that what we're seeing is a little bit more investor interest towards India, not just as an emerging market, but as an emerging market that's going to become a very developed market over the longer term. And we're just seeing a little bit of rebalancing into the MSCI and some of those shares taken away from China because China's had so much influence over the past decade or so, and there's just a little adjustment towards India based on its own growth story and what's expected over the coming years.
Great stuff. Thank you so much, Jameel, but please do stay with us for more discussions down the program. Welcome back. The U.S. July Consumer Price Index came in at 2.9%, down from 3% in June. Inflation has slowed for a fourth consecutive month, reaching the lowest level since March 2021. The declining trend also held true for the core measurement of the CPI, which has come down to 3.2%. And another gauge of inflation closely monitored by the Federal Reserve, which is the Personal Consumption Expenditure Price Index, or the PCE, will be unveiled at the end of the month. In the meantime, the U.S. housing market has hit a record high in total value, according to analysis from Redfin Estimate. As of June 2024, the total value of the U.S. housing market reached a record $49.6 trillion, up 6.6% on the year, and it has more than doubled in the past decade, climbing nearly 120% from $22.7 trillion in June 2014. Analysts say that housing prices are likely to continue to rise at a slow pace, which is challenging news for first-time buyers. And a report from Zillow found that the typical starter home cost $1 million or more in over 200 U.S. cities this year, way above what the average American can afford. But starter home prices have jumped more than 54% over the past 5 years, causing many young Americans to delay their first home purchases. Now let's get some discussions on the U.S. latest financial data and the economic performance of the country. Let's bring back Jameel Ahmad, Chief Analyst at GTC. So Jameel, in light of the July CPI numbers, inflation numbers, and of course the latest U.S. jobs report, what are the implications for the Fed's rate decision in September?
Well, it's very good news if you're looking for lower interest rate policy because we've just had the U.S. inflation reading that's come out moments ago. And it's the lowest inflation we've had since more than 2 years, closer to 2.5 years. And in fact, we're seeing now resuming progress when it comes to the US CPI coming towards the Federal Reserve, which is the US Central Bank's target of 2%, because actually over the past 1 year, we've seen inflation stagnate somewhere between 3% and the higher 3.5% range typically, while inflation's made a lot of progress against where it was 2 years ago at the 9% peak. We hadn't actually moved below 3% convincingly until what seems to be today. So this is good news for the Fed. It does put even more bacon into the cooker, really, that the Fed are going to lower U.S. interest rate policy in September, which the market was already expecting. But actually, it does also increase anticipation that we might get more U.S. interest rate cuts over the course of the remainder of this year. And that's something the market's been waiting for questions for and clarity for a long time. So I think investors will react positively to this. And in fact, gold prices looked at look like they're just coming within dollars now of a new all-time high, and I do think that that's more likely than not going to break it over the coming sessions.
Okay, now shifting gears to the U.S. real estate market, a study from Zillow shows that the typical starter home that costs at least $1 million in more than 200 U.S. cities. Now, that's the highest number ever. There has been concerns and debates and voiced on whether there is a housing bubble. What is your opinion?
Well, we've had the same debate now about the stock markets and moored stock market bubbles for close to 10 years. But in fact, if you look at the course over this year, we're seeing unprecedented highs in moored equity markets. And I think the same can also be applied to the housing markets too. I think the word bubble is used a lot. Typically, housing markets worldwide have faced a huge challenge over the past year or so from high interest rate policy. And they've passed that test. I think the issue at hand now is about core economics. And in fact, house prices and the cost of living continues to go higher, but wage growth is not mirroring the same pattern. So in fact, disposable income is lower, and actually wage growth is not moving anywhere near as high as what it should be in reference to and relevance to housing prices. Another aspect is towards the bubble is actually the US housing market structured very much differently. Mortgage terms are set over 20 years, 25 years or so, which is much different to Europe, where you have housing market and mortgage rates that move from 2 to 5 years. So that's another thing that actually supports the US housing market. But I'm not going to say that house prices are not too high for first-time buyers and that wage growth should move more in line with the real-life challenges that potential homeowners are going to face.
Well, great insights. Thank you so much, Mr. Jameel Ahmad, Chief Analyst at GTC for us.